Welcome to the Explainer. So if you're gearing up to completely crush the CFA Level 1 exam, or honestly, even if you're just super fascinated by the hidden gears of financial markets, you have landed in exactly the right spot. Today we're diving headfirst into what is essentially a financial detective story. We are hunting for risk-free profit in the options market. We're going to decode this concept called put-call parity. Now, I know it sounds a bit intimidating, but stick with me. By the end of this explainer, you're going to see exactly how arbitrageurs hunt down pricing errors to make guaranteed locked-in money.
Here is our game plan for today. We've got 5 quick sections: the law of one price, 2 paths, 1 destination, the Infosys heist, building a synthetic stock, and finally, surviving CFA exam traps. Let's jump right in.
Section 1, the law of one price. This is basically the golden rule of finance, the one thing that prevents absolute chaos in the markets. To really understand this rule in the derivatives world, we have to look at put-call parity. It's a mathematical relationship showing that different combinations of options, stocks, and risk-free bonds can actually replicate each other's exact payoffs. Basically, it connects call options, put options, the underlying stock, and a risk-free bond together as long as they share the same strike price and expiration date. Think of it as the ultimate tool for making sure everything is priced consistently across the entire market.
Okay, here is the magic formula. C plus PV of X equals P plus S0. Don't panic, it's simpler than it looks. C is just the call option price. PV of X is the present value of the strike price. You can think of this as buying a risk-free bond that matures to the exact strike price. P is the put option, and S0 is today's current stock price. Now, I know this looks super abstract right now, but we are going to bring this totally to life.
Let's imagine you're setting up 2 completely different magic portfolios. For portfolio A, you buy a call option and you invest the present value of the strike into a risk-free bond. For portfolio B, you go a totally different route. You buy a put option and you buy the actual underlying stock. Put-call parity basically dictates that if these 2 completely different portfolios have the exact same future cash flows, they must have the exact same price today. No exceptions. Which brings us to section 2. 2 paths, 1 destination. Let's actually prove why these completely different setups are identical twins when expiration day rolls around. We'll set our strike price at exactly 1,000 rupees. Walk with me through this first scenario. Let's say the stock just absolutely skyrockets above our 1,000 rupees strike price. It goes all the way up to 1,200 rupees at expiration. What happens to our 2 portfolios?
Well, in portfolio A, your call option is in the money, so you exercise it using that 1,000 rupees your bond just conveniently paid out. Boom! You now own stock worth 1,200 rupees. Now look at portfolio B. You already own the stock, which is now worth 1,200 rupees, and your put option, it simply expires worthless. So both portfolios end up holding the exact same value.
But wait, what if the market completely tanks? Let's flip the scenario. What happens if the stock crashes way below the strike price, dropping all the way down to 800 rupees?
Believe it or not, even in a massive crash, the math holds up perfectly. Over in portfolio A, your call option expires worthless this time, sure, but your risk-free bond matures and hands you 1,000 rupees in cold hard cash. Over in portfolio B, your stock has lost a bunch of value. It's down to 800. But your put option kicks in and allows you to sell that stock at your guaranteed strike price of 1,000 rupees. So the absolute crucial takeaway here is, whether the market goes to the moon or crashes to the floor, both portfolios guarantee the exact same payout. Therefore, their prices today absolutely must be equal.
Section 3. The Infosys heist. Spotting risk-free arbitrage profit. This is where it gets really fun. Let's look at a real-world case study to see how traders exploit this exact math. We just established that the prices must be equal today, but what happens when the prices don't match? This is the million-dollar question, because when prices differ, an arbitrage opportunity suddenly appears in the wild.
Imagine you're a quantitative analyst. You're sitting at your desk, and this raw Infosys market data hits your screen. The stock is trading at 1,500. The call is 120, the put is 40, and the present value of our strike is 1,400. Instantly, your brain should start running that parity formula.
Let's stack these 2 sides against each other using our formula. Portfolio A, right? The call plus the bond. That's 120 plus 1,400, giving us 1,520. Now portfolio B, the put plus the stock. That's 40 plus 1,500, giving us 1,540. Wow, this brilliantly illustrates a glaring 20 rupee mispricing by the market. 1,520 does not equal 1,540.
So what is your ultimate move here?
It's literally free money. It's simple. You sell the overpriced portfolio for $1,540, and you instantly buy the underpriced portfolio for $1,520. By exploiting this little gap, you pocket a 20 rupee difference immediately today. And because we already know both portfolios will have the exact same value at expiration, you have just locked in a guaranteed zero-risk profit. That, my friends, is arbitrage trading in a nutshell.
Section 4. Building a synthetic stock. This is literal financial alchemy. Big institutions like Goldman Sachs, Morgan Stanley, and Citigroup use this exact formula to create assets out of thin air without actually having to buy the underlying shares.
If we take our trusty parity formula and just algebraically isolate the stock price, we get this. Stock equals call plus PV of strike minus put. What does that mean in plain English? Step 1, you buy a call. Step 2, you buy a bond. Step 3, you sell a put. If you combine those 3 moves, your portfolio behaves exactly like owning the stock itself. You've essentially just created a synthetic stock.
You can think of this as a conceptual cheat sheet to instantly translate boring algebra into real, powerful trading strategies. A stock plus a put, that's economically equivalent to portfolio insurance. A call plus cash, that equals protected upside. Understanding these relationships is absolutely vital for market making and constructing complex, structured products.
Finally, Section 5, Surviving CFA Exam Traps, the Survival Guide. If you're a candidate watching this, let's focus directly on crushing this topic on exam day.
I'm going to rapid fire the most common and, frankly, painful mistakes candidates make. Mentally bookmark these right now, okay? Number 1, forgetting the present value adjustment. Number 2, using the spot strike instead of the discounted strike. Number 3, getting confused by those synthetic relationships we just built. And number 4, entirely ignoring dividend assumptions.
Speaking of dividends, notice how they completely change our baseline equation. If a stock pays dividends, you absolutely must add the present value of those dividends to the call side of the equation. Why? Because dividends affect the actual value of owning the stock. The CFA exam loves to throw this curveball at you, so always double-check if the stock pays dividends.
Okay, here are your final pro tips for exam day execution. First, as soon as you sit down, write the parity formula on your scratch paper before doing anything else. Second, substitute your values super carefully. And third, and most importantly, focus on the arbitrage logic, really understanding why the portfolios are equivalent rather than just blind rote memorization. If you truly understand why the portfolios must equal each other, you can rearrange that formula to solve literally any question they throw at you.
So, to quickly recap the essential takeaway of this entire explainer. Put-call parity is a no-arbitrage relationship showing that combinations of options, stocks, and risk-free bonds can replicate each other's payoffs. That is exactly why the law of one price reigns supreme, ensuring consistent pricing in financial markets and serving as the absolute core building block for advanced stuff like the Black-Scholes model.
We've just seen how mispricings create these awesome risk-free profits. But in today's hyper-fast markets, algorithms and high-frequency trading bots are policing these exact parities in milliseconds. I mean, that 20 rupee Infosys gap we looked at, it would vanish in the blink of an eye today. So it leaves us with a pretty fascinating question to ponder. With all the easy math constantly being corrected by machines, where's the next frontier of arbitrage actually hiding? Thanks so much for joining me on this explainer, and hey, keep hunting for those opportunities.